So I guess let's intro the guests. Kylie, co-founder and partner of Eleanor Ventures and Flying Fox Ventures. Kylie was a corporate lawyer for 20 years. Then she started an innovation lab. Then she launched a health tech startup. And now Kylie is making moves into angel investing and venture capital. So Kylie's invested in over 20 great Australian startups, and many of them are alongside Rayn. I think Kylie and Rayn know each other through the angel investing ecosystem. Rayn is probably Australia's best known angel investor, and Rayn has made over 60 investments into startups himself. Rayn, what Rayn's really known for is being incredible at helping founders. So Tim Doyle, the founder at Eucalyptus, said about Rayn, if you're building a company, Rayn should be one of your first stops. Rayn's known for helping in any way he can, and that includes wearing startup t-shirts. So Rayn, how many startup t-shirts do you have in the collection?
I actually lost count, probably around 100.
Okay, well, I probably would have lost count way before 100. So, okay, finally, Marvin. So Marvin's so kind as to join us from the US. Marvin has a pretty incredible background. Marvin spent 10 years at Yahoo, where he held multiple executive roles. After that, Marvin spent 6 years as a partner at 500 startups. And at 500 startups, Marvin invested in over 414 companies. Yep, 414. And now Marvin's a well-known angel investor and advisor to several startups. So to get things kicked off, we'll start at the basics and then dive into the weeds. Marvin, I'll start with you. Could you just please describe what angel investing is and also a short outline of how it works?
Okay, sure. Angel investing is basically you're investing in an early stage startup with your own money, right? And I joke it's sort of like you're doing it partly, I think if you're doing it for profit, I think you're a moron. I think you do it mainly for fun. And I jokingly call it startup and sort of like it's startup charity. It's just as ironic that I'm actually on this panel because I was an awful angel investor, and I maybe get some quick sort of context or just I left Yahoo, I think end of 2011, beginning 2012. So I actually had some money and I was like, I'll just do the startup investing thing. Seems easy. Everyone's making money. I did 8 deals and I mean, it was a complete, I didn't know what I was doing, if I'm super honest, but I was arrogant and I didn't know what I was doing and it's all gone, right? And I joke of just like, it would have been better if I took that money and put it in a bathtub and set it on fire because at least some of the backdraft would have sent some of the money back to me. My wife is still pissed off at me. But having said that, that was actually incredible for me as education. If you think about it from angel investing, I got to work with amazing founders, even though the companies didn't work out. You learned a lot. So it's like, there's nothing better than losing a bunch of money because then you get really good, right? Of just like you start building your own mental models of what you should be investing in, how you think about deals. And so anyways, I think everyone now should be doing angel investing or at least have some portion of it, but make sure if you're going to do it, like it's the stuff that you can afford to lose, right? Like any investing you do, you should be willing to sort of like lose it, but you will learn a lot of stuff from doing it. Sorry, that was a long-winded answer, but it's basically you're investing your money for profit and for fun. And I would say more for fun. If you do it well over time, you'll make some money from it.
So really interesting thing, Marvin, you said is that everyone should be trying angel investing simply just to learn and for fun. Now, in the US, you need to be an accredited investor to angel invest. In Australia, that's called a sophisticated investor. Kylie, considering, I guess, sophisticated investor overlaps with law, and you were a lawyer for almost 2 decades, would you just be able to step through what's meant by sophisticated investor and how might non-sophisticated investors, i.e. everyone who isn't hyper wealthy, invest?
Sure. Sophisticated is just, it means rich. It does not mean sophistication, and there is usually very little correlation between the sophisticated and the rich. But that's the test that we're stuck with. So you need to get a certificate from an accountant certifying that you have assets of 2.5 million Australian or income for each of the last 2 financial years in excess of 250K. So they're pretty hefty thresholds. You don't always have to be a sophisticated investor. So to invest in a fund or to invest in a commercial syndicate, you will need to be a sophisticated investor. But if you don't have your rich person certificate, there are some other options open to you in Australia. One is to go down the crowdfunding path, which has a different set of exemptions. They are normally more consumer focused rather than, you know, there's a different kind of startup that is better suited to equity crowdfunding in Australia. It's not better or worse, it's just different, but you need to be mindful that you will only be seeing that subset of companies if you do equity crowdfunding. The other one is to prove your worth to founders that you meet by taking up one of their non-sophisticated spots. So all companies under the Corporations Act have the ability to issue a small number of shares every year, refreshes every year, to non-sophisticated investors. There's a bunch of other exceptions. I'm not going to completely bore you with Corporations Act exemptions on my first question. I'm such a nerd, I'm sorry. But you know, they have some, there's not many. That's how they issue shares to mum and dad and, you know, other people. Not everyone on the cap table is always rich. But because a company can only ever have 50 shares on its cap table without triggering another set of regulation, that's when it goes up to become a public company, they're always very careful of how many slots they sell. So if you are not sophisticated, chances are you're not going to be investing big checks, which means how are you going to convince a company to take your 10K, maybe your 5K? And that is some of the best angel investing is done when you can show how helpful you can be and how aligned you are and that you are worth more than just your 5K check. That's how you know, kind of buy your way onto a cap table, is with all the other benefits that you can deliver. I'll stop talking now for now. Sorry.
No, that's a great segue into what I was actually hoping to ask Rayn. So for everyone here, Rayn is now kind of known as a celebrity angel, which means it's a lot easier for Rayn to get access to deals. I was chatting to a founder actually 2 days ago, and they said they're not really wanting angel investors on the cap table and are more going for VCs. And then I said, oh, what about Rayn? And they said, oh yeah, for sure, I'd have Rayn on the cap table. So Rayn, I guess the question I have is, early on, before the process of actually making successful investments and building a reputation, what did it actually look like getting this allocation? Because as Kylie mentioned, companies have 50 spots on the cap table, 50 investors they can have. So yeah, what was the process of searching for startups and also getting an allocation to startups?
Yeah, I think before I answer the question, we need to explore what we're searching for, right? Like what does greatness look like? Good team and good company. If you spend enough time to evaluate the currently successful company, not just the Canva of the world, you know, like the 50 million valuation companies, the $25 million valuation companies, and then you can think like the founders, right? Like where would they hang out, you know, and who would they hang out with? And that's where you find all the good deals. In terms of, you know, your comment about the founders just now, maybe they are targeting me because I'm quite easy to close. Because I do have a spray and pray approach. You know, we put a little bit of money into many deals and we only talk about the good ones. So it creates this atmosphere and aura that I'm in all the good deals, but you know, the fact is I'm actually in all the deals.
Gotcha. Okay. I guess we'll probably get into it a bit later, but in a way it could potentially make sense to make lots of bets as a way of risk management, but we'll probably get into that. I'm keen to hear also from Marvin a similar question, how you have thought about, because Marvin, you're from the US, I'm presuming there are a lot more angel investors in the US than there are here, which potentially means it's a lot more competitive to get into deals. So Marvin, how have you thought about getting an allocation to deals and doing that?
Yeah, it's crazy. It's ridiculous now from a competitive landscape perspective. It just, money's a commodity, right? And there's just so many really good investors and really good operator investors. Now we're calling these, and then we have a new set of folks who we call like distribution angels. guys like, one of my good friends is a guy named Anthony Pompliano, who, is a very well-known sort of like influencer type. And he was an investor, but now influencer type. And it's just like, wow, like, knowing sort of how quickly the hottest deals actually sort of are able to raise, just like, you need to be able to show up and actually add what I call sort of like a high value add, just sort of like money ratio, of just like, hey, I can do all these things for you. Here's why you should let me, like, give me some allocation, right? And so I do think it's a combination of like, do you have a decent brand? Do you have a good reputation? Like, reputation is really, really important. Of just like reputation, not just with the good companies, but even the reputation with the companies that don't succeed. Like, were you a dick? Because if you are, people are going to find out. And so I think these are the kind of things that people evaluate. And in a highly competitive situation where I would say the best founders get to pick and choose their investors, like you at minimum just need to be sort of like, as they say, sort of like do no harm. But I think the bar is so much higher now. There's all the founders are just way more sophisticated now. They're like, what are you going to do for me? Right? Like, I'm building this awesome company. I'm letting you be part of this ride and journey. Like, can you help me get customers? Can you help me think about fundraising later on? Can you help me do whatever, right? Like whether it's BD or product or design stuff. I think you really have to show up the table being very, very clear about what you can do and what you can't do.
Yep. It's reputation's a very interesting one. I guess the banner that's kind of going under nowadays is personal branding. And whether people here are university students looking to build a reputation and personal brand for jobs afterwards, whether it is a startup investor looking to build a personal brand to be seen as someone who adds value. I think this idea of personal branding finds lots of exemplars in the realm of angel investing in particular. I'm keen to open this up to all three of you, but Marvin, how about we start with you just as a follow-on? People like, I guess, Anthony Pompliano and others, and yourself as well, what do you reckon they do so well about building personal brands?
I actually think like writing online, like whether it's like, and I use online, like, here's the thing, the way I think about it, just like the future is basically like media company of one, right? So, you have a bunch of guys like you can do a podcast. I know lots of investor friends who that's all they do is podcasting, right? I have lots of investor friends, they do Twitter. Like Twitter's an incredible channel, and not just retweeting, but actually putting original things out there and being thoughtful about it. Blogging has been a tried and true journey, but I actually think writing online well is actually really a critical skill, not the garbage they teach you in university, what writing looks like, of just like real good business communication, like deep, insightful stuff, right? Or memes. There's some VCs who are completely building their, like Turner Novak. He's like the meme king of VCs. He's built an incredible brand of just being the meme guy. So I do think there's a lot of things you can do now with social media that you couldn't do before. And if people want to learn more about it, like whether you like Gary Vee or not, he's actually done an incredible job. Like he's written books on this stuff. Like his first book, I think, Crush It or Crushing It, that came out in 2009. If you go and reread it, it's still really valid to building your own personal brand these days.
Okay, yeah, I think it's interesting how you're drawing like the analogs, not just within VC, but also people like Gary Vee, and I think it's a sharp point.
Gary Vee is an incredible investor. He's an incredible investor. His portfolio, he's made way more money from his investment portfolio than I think his core business.
Wow. Okay, and I guess that speaks to like my perception of him as well through just the amount of media he's had in terms of not seeing him as the investor, but still knowing his name. So like personally, so Kylie and Rayn, from your perspective, what have you seen, I guess, yourselves and also others do to build a brand and personal reputation?
I'm going to probably come at it from the opposite way that Marvin did, and not to discredit what he said, but you don't have to be about self-promotion and comms first. That the way that I built my brand was just one deal at a time, doing the work, plodding along, slowly building that reputation. Maybe Australia and America are different, but you don't kind of arrive on the scene with a whole fanfare. Like you have to do the work. And it's hard, like to invest at the rate that Rayn and I are. I know that both of our numbers, I think both of us have doubled the numbers that you quoted on the intros, to invest at the rate that we do. it's a shit ton of work. And having a process around that, being clear around with your founders, and if you invest with other people, around what that process is, and just, you know, that kind of commitment to excellence. You know, it's a small ecosystem and people will respect you for that.
Yeah, I totally agree. I participated in deals, you know, on Kylie's platform. So, you know, doing the deals is definitely quite important. I can share, you know, my 4-step process to build my personal brand. Step 1 is have money to invest. You know, step 2.
That is, sorry, can we just, I just want to like emphasize that, like, particularly in Australia, there are so many investors out there who don't have money to invest. And if you want to be an investor, you need to have money, you know, like that's what this is. Helping is great, but sorry,
You'd be surprised at how many people hit me up. They go, I want to get a meeting with you, want to invest with you. I'm like, how much do you want to invest? They go, I don't actually have money to invest.
Yeah.
So have money to invest, and then I force the founders to write a LinkedIn recommendation right after I invest. That's the best time. If the company fail, hide the recommendation. You know, if they get on AFR, harvest the hype as much as you can. So you build that aura around you, and that kind of kickstart the flywheel to go, oh, that guy is pretty cool. He hits all the good companies. I want to be part of that club. You know, you get the founders come and talk to you first. And I also want to emphasize search engine optimization, SEO is really important. You know, how many Ryan do you know, and how many Rayn do you know, right? So sometimes when your dad cannot spell Ryan, that's actually to your advantage.
Can I just want to challenge something that Rayn said, and we know each other well enough to riff a bit, so excuse me, but you know, Rayn has built a personal brand as being quirky and funny, and that's his public persona. You know, I collect t-shirts and I have people write me LinkedIn reviews. Like, Rayn does more work than anyone I know, you know, so it's not, you know, he built his reputation on hard work. And once you have that platform of understanding the fundamentals, then you can add your personality and your quirk and your stuff on top. I don't think you can skip that step, because Rayn is, you know, one of the hardest working angels I've ever worked with. Thanks,
Kylie. I definitely have done my 10,000 hours of foundational charitable work.
So, guys, I'd highly recommend hopping on Rayn's LinkedIn and scrolling to the bottom and having a look at the recommendations Rayn talks about. It's on his list of 4 things he does, and he definitely is doing it. So I do recommend checking them. So I guess we had Marvin with the blogging and the Twitter and the different ways of putting yourself out there in that way. Kylie emphasizing the importance of giving good advice and going deal by deal and building up a reputation by doing things right. And then I think Kylie's point about Rayn having personality and actually having this image around him is like quite a meaningful one as well. If we move on from the idea of branding into, I guess, like the meat of angel investing, actual decision making, there's this age-old debate that when you're investing, what's more important? Is it the product, so what they're actually building? Is it the team? Is it like the founders, the founder and co-founder? Or is it the market? Is it investing in $1 billion market or the next $1 trillion market? I'm keen to just open this up, Marvin, Rayn, Kylie, to all 3 of you. And I want to spark a little bit of debate as well around what you're looking for in particular when investing, and whether you think product, founder, or market deserves more weight when making decisions. We can probably start with Marvin, I think.
Yeah, I don't know. Honestly, I think this is my view. I hear and see these debates, and I think they're kind of ridiculous because I think they're all important. But I can tell you sort of my calculus where, you know, I'm investing typically at the, you know, how you look at deals is depending on the stage that you're actually in and what your expertise is. And so the things that I actually care a lot about, I care a lot, like 70% on the team and maybe only like 30% on the market. And by the way, like, you get the market thing wrong all the time, right? Like, markets you think that are big usually are not, or not as big as you think they are, or maybe your timing's off, or a lot of times it's just like you actually completely miss how big the market can be. But I think like you need both, right? Because just to give you context of why I think this way, I think most of my, like I'd say half of my super successful startups have ended up pivoting their business model, end up pivoting sort of like the end market they go after. So you don't know what they're working on right now is necessarily going to be the thing that they're doing, but is this just a really good team? I think that is valuable, but it's the same time, you can have a great team go after sort of a not great market. Doesn't really matter. That outcome's not going to be important. But I hardly disagree with this idea. It's like only thing that matters is market. Because like what happens is a lot of companies fail in the scaling stage. So even if you do a great job sort of like picking the right market, and that's hard to do, by the way, but going after a big market that's growing really fast, a lot of times because these people aren't necessarily great. And I use that term to, sort of with sort of like asterisks of great, they can't scale the business. They can't hire people. They have crappy judgment. And so they just can't take advantage of that opportunity. So there's a lot more art than science, I think, in this. And it's a data sample set thing.
So, if Marvin, if it's 70% on the team and you're looking for those great founders, what do you reckon in particular? I'm guessing you have a bit of pattern recognition experience through 414 startup investments at 500 startups. What in particular do you reckon makes a world-class founder?
I mean, here's the way I think about it, right? Like, I don't think there's one specific trait. There's maybe 2 or 3 things that I look for, where, like, are they learning machines? Like, like I'll give you an example. Like, I try not to invest in rich kids because they tend not to do very well. They don't have the grit versus somebody, or it's like, has this person actually like been an athlete or something and just like taken their punches in the face, right? Or had some major failure before that they've come back, And so I look for these type of things. But the reality is, because I have a very large, like I'm looking at this sort of, as someone who's been doing this for a while. So one of the things I look for is just like, how does this person compare to, like one of my like top 10 percentile founders, right? Out of my portfolio, about 35 companies drive pretty much 90% of the returns. And so, I kind of do the pattern recognition. How does this team and person compare? And the reality is that every time when I do the comparison, I still do the deal. I literally just did one that was like, they're not a top 10. I know I'm going to regret it. And I literally just did one like about a week ago. And I'm looking back on it, I'm like, yeah, pardon my French, I kind of effed up. I just don't know. I think it's a great opportunity, but I think I screwed up there.
And Kylie and Rayn, I'm keen to hear your points as well on founder versus market versus the product. And as Marvin said, you do need all 3, and I feel like there never will be one straightforward answer, but I will open it up.
I don't have a lot to add. Marvin kind of covered it beautifully. Product is the least important. Team is the most, important, and but you need all of them.
Good team can make a shit idea work sometimes, but you won't make money that way. Good team can make a good idea fly. That's where when you make money. Shit team is just shit team, though.
Okay.
I mean, sorry, Max. I just add one thing. It's like, this is really hard, right? Like, I'm like, so just for the record, right? Just like, look at lifestyle of an angel investor. Like, yeah, it's not hard per se, right? But it's really hard to get good at this, right? Because I think like you hear this from VCs, and this thing that bugs me most. This is why everyone hates VCs, right? But the reality of the arrogance of VCs are like, oh, I knew when I met them they're going to be hugely successful. That's garbage. That's complete garbage, right? Like, I look back at my portfolio and go, the only thing I can legitimately say was that when I met these folks, I knew they were going to be successful in life. I didn't know if they're going to be successful with this specific company, this iteration of their career. It's really hard to figure out.
Yeah. And I feel like that in a way could make sense, because you have excellent founders who are excellent, but they have also failed on 1 or 2 or 3 startups before hitting the home run. But
sometimes more.
Yeah. But then the flip side of that is, if you invest in them each time, even if you hit 4 fails with the one founder who you think is superb, well, the home run hopefully pays off for all 4 or 5 or 10 of the failures. Rayn, something you said earlier was that part of the way you have access to deals, okay, there's the reputational point, but it's also by placing yourself where these exceptional founders are. Would you be able to maybe dig into that a little bit and explain what you mean by surrounding yourself by great founders, if it's not IP?
I mean, I can only look at so many deals, right? But we have probably 100 portfolio companies now. 2 co-founders each. That's 200 founders, and they are in the field all the time. People are asking them for advice and asking them for tips on how to fundraise. So if they are successful and they grow and raise, people will go to them, and if they have a good experience with us, they'll refer them to us. So then you kind of increase your surface by 10 times or more, like 100 times, 200 times in this case.
And what proportion of your investments do you reckon are referrals versus someone reaching out cold to you versus some other channel?
I would say I get a lot of cold ping from LinkedIn, but my strategy is I look at how many common connections we have. If we have less than 20, I'll take the meeting no matter how shit the idea is, because this person is outside the network. If we have 500 common connection, I'm like, everybody has seen this deal usually. The deals that we normally do will be through referral, through the founder's referral, or in my case, because I normally play in round 1 and round 2, we get quite a fair bit of venture funds manager. They go, hey, this is a bit early, but I want to see this happen and that happen. Why don't you bridge them until that happens? So, we do quite a fair bit of deals that way.
And Marvin, how about the same for yourself?
Yeah, I don't do cold, right? Like the filter for me is just like anyone cold pings me, I think is an idiot. And I'll tell you why I don't think cold works. Like I have thousands of I'm known in the space. Like if you cannot find somebody that's going to vouch for you, like I've invested in, what is that? I'm going to see at least like 700 founders out there, right? Like that can probably find a way to get to me. Like if one of my founders actually makes an intro, I will always take the meeting. They're like, would you take this meeting on? Look, if you're introing them, I just by nature just have to take that meeting, right? So you cannot find one of my founders. If you cannot find an investor friend or some player in the network to sort of like intro you to me, that's willing to vouch for you to intro me, you probably are not very good. This sounds very unfair, but like you bear in mind that I'm based out of SF, right? Which is like where the center and the densest part of the network is. You can't find a way in. And then, about a third of my portfolio is outside of the US. Like if you cannot find a way into sort of my network, I think there's something wrong with you. And you're like, lots of people are like, well, it's so unfair. Okay, life is unfair, but the point I'm trying to make is just like, I'm in a dense network, and this is actually a test, right? It's a test. Can you find a way to get to me? Because this is the same way of just like, it's like a proving ground. It's like, can you're using this methodology to basically hire people, using this methodology to get to other investors, using this methodology to get customers. You cannot go and figure that out. Like, how good are you? And so fair, unfair, this is just sort of the way I look at it.
And Kylie, you probably came to the game a little bit later than at least Rayn, having had 2 decades as a lawyer, founding an innovation lab, starting your own startup. What did it look like at the start for you to try and find these deals and place yourself where founders and startups are coming to you?
So when I started by joining angel groups, which at that stage, I love the kind of flattery that you're giving me there by implying that I might not be as old as I promise you I am. I've been around in this game for quite a while, but I'll take it. When I started going to the angel groups, they were still quite nascent. And there was some issues with kind of deal flow and, that decision by consensus, and, groups would, kind of fall into this analysis paralysis. So we weren't necessarily getting the best deal flow. But I met some people, and I took those people and we met more people. And then I just started kind of finding my tribe, because investing is a team sport. And we are not at the center of the universe here in Australia, like this is not Silicon Valley. So you have to work harder to find your people. And then once I found the other investors that I liked to work with, then it just kind of spread from there. It was, when I started investing, there were, far fewer events and accelerators. That the ecosystem was just a lot smaller than it is now. So getting access to founders was not an issue. It was more about finding the right people to help me, kind of upskill and become a great investor.
I'm not sure if this is a relevant consideration, but with the all these new accelerators and really the startup ecosystem taking off, I presume there's a little bit more noise, and it could be harder, whether it's to find other good investors or find other really good startups. Is that something you've really thought about much? And is there a way of filtering the noise versus just looking at 1,000 startups where you previously would have had a look at like 100?
Well, if you look at 1,000 bad companies, you won't get any good companies. Right? You want to follow experienced people and go, hey, why do you want to invest in that one? Tell me why. And then you keep asking everybody why. It's a trial by fire thing. And even the experienced people, is wrong 50% of the time, more than 50% of the time. So
90%.
90% of the time, yeah. So so definitely, find your tribe and have enough cash to suffer a few hits. Don't go think, I'll invest in 2 companies and one of them will be, 1,000 times return.
Yeah, what I'm hearing that's really interesting is almost like crowdsourcing decision making by others who also have like diverse points of views and other ways of thinking about things. Marvin, I noticed you're going to say something.
You nailed it. I just like, I do worry about sort of like groupthink, right? This is why I'm super negative on angel groups in general, especially angel groups of people who aren't from the tech industry, because they look at it's not necessarily unhelpful. Just I don't know. So like, okay, what are you going to learn? You learn how not to invest, right? Or do you go this consensus? But one of the things that I'm very, very conscious of is just sort of like your own understanding, your own cognitive biases, and it is helpful sort of discussing deals, like why I think partnerships matter, or at least like, a lot of deals I get either from my founders, right, or from other investor friends. And I try not to invest with consensus, because I do worry of just like you've heard this term, like no conflict, no interest, right? And so the best deals I've done were highly, highly contentious. When I was at 500, all my best deals were highly contentious. And so it's just, I always worry when everyone hates a deal, I'm like, okay, what are we missing? And maybe we're not missing anything. And then the second part is just like, if everyone loves a deal, I'm like, we're clearly missing something, right? Or we're probably late.
So Jesse had a really interesting question in the chat, which is, if you're taking deals from your network and you want the warm intro, how do you then go about minimizing the groupthink?
My network is super diverse, right? Like I have angels from all over the world, I have founders from all over the world, I have VCs at different stages, and also like male, female, different colors, different sort of like denominations. Like just you have to have diversity in sort of like your group on your team, but also diversity in the people we hang out with. And that's something, I don't know if I was intentional about it, but just have turned out that way, right? So I'm very, very conscious, so I'm fairly conscious about that.
And if I guess that segues nicely into the idea that if you three were building an investment curriculum, an investing curriculum, angel investing, let's say, for someone with very little experience, but say 10 smart, driven students, what would that investing curriculum actually look like?
I would recommend you to go and watch the Blackbird Sunrise conference from the very beginning, when they showcase some of the most successful companies in their early days, year 1 and year 2, and what actually, what was the inflection point of those companies. And then that will give you a good idea of what, great things look like in the early stage. Like Marvin said, it's often quite weird and often quite misunderstood. But, after a while, you can kind of catch a pattern, and, that will be an interesting thing, to know. And then also about your risk management framework. So in my case, I do small check upfront, I do heavy follow on, and then I'm quite diversified, and I have a way to, take my principal back when it's at a certain point and I reinvest. So, after a while, if you hit 100x, then you're playing with profit, then, you don't actually have that much stress. Then you can be quite weird with how you invest.
I'd love to dive into that risk management framework, but I think first, Kylie, I'm keen to hear as well, how you would think about building this investment curriculum for 10 intelligent-driven students.
I mean, we have done it time and time again, right? Like we delivered the first Google Angel program, you know, where Google tapped us to come and teach Googlers how to angel invest. You know, we've helped StartMate and Airtree build their internal programs, and we teach. Rachel has devised the whole Wade Institute program with obviously a lot of help from faculty members there, and Rayn and I have both been part of the UNSW Angel Investor program. All those are great places to learn the fundamentals, you know, like the curriculum is there. But if I was to pull one lesson out of all that, and those programs run from kind of, you know, I think that the AGSM one is 3 days. We did Google School over 8 hours, which was fun. And then Wade Institute is 2 weeks. The one thing that I would pull out is the importance of diversification. You know, you cannot find the winner. None of us can. So whatever number of whatever check size you think you can write, you know, divide it into 20 at least. You know, like 20 is table stakes. And if you can't write 20 checks, then you need to find another way to invest in this asset class, whether it's through a syndicate or through a fund. You can't, or maybe your deployment period is longer. You know, maybe it's like, well, I can only invest, you know, 10K a year, but I'm going to try and, you know, I might try and get into a syndicate and do some small checks that way, but my deployment period is going to be over, you know, like 7 years or however you want to do the maths. Just unless you can get the spread, you will fail. It's the only way to make money in this asset class. And, you know, going back to Marvin's point, you know, is maybe investing in this asset class doesn't need to be primarily about returns. I disagree with that. You know, like I don't think of this as a form of philanthropy. I like to keep my philanthropy separate from my investing. I'm here for the returns, and I don't think there's anything wrong with that. And the programs that we teach are designed to kind of, you know, equip people with a process so that they can maximize for those things. You have to be prepared to risk it all, you know, like you don't bet what you can't afford to lose. I completely agree with that. But, you know, the thinking through the whys of what you want from this process is important, because if it's to hang out with founders and just be part of the ecosystem, there's cheaper ways to do it. You know, you don't need to be, you know, to be a startup super fan. You don't need to spunk, you know, 100K. You just don't.
Great. Thank you so much, Rayn, Marvin, and Kylie. Incredibly generous of you three to join us. Share all your insights from being on the inside and in the know with angel investing. So thanks again. And everyone here, I'm sure, is incredibly grateful for having had the opportunity to listen.